Market makers use delta-neutral hedging to eliminate directional risk. By continuously offsetting their options positions with the underlying stock, they aim to remain completely indifferent to market movements. Yet the algorithms designed to enforce this strict neutrality are actually the primary drivers of violent intraday price momentum. The standard industry explanation for this momentum is aggregate short gamma positioning. The narrative assumes that whenever market makers are caught broadly short on gamma, their forced hedging mechanically squeezes the underlying stock in the direction of the trend. The empirical data contradicts that assumption. Tracking aggregate short gamma exposure on its own is statistically a very poor predictor of localized intraday volatility. The actual catalyst for a momentum squeeze requires crossing a specific mathematical inflection point known as the gamma-theta break-even range, or GTBR. To understand this mechanism, we have to track the intraday profit and loss constraints of a market maker holding a short gamma, delta-neutral portfolio. The daily ledger of this portfolio is governed by a strict tension between two forces. On one side is theta, the steady, linear profit accrued as options lose time value throughout the day. On the other side is gamma, which generates accelerating losses whenever the underlying asset's price deviates from the strike. Our objective is to map the precise underlying price boundary where this delicate balance collapses, making delta neutrality mathematically untenable. By identifying this exact threshold, we can calculate precisely when liquidity providers are structurally forced to transition from volatility absorbers into momentum multipliers. The structural mismatch in a delta-neutral book comes from the differing profiles of the assets involved. The market maker is short an option, which has a convex payoff profile, while they hold a linear hedge instrument, like the underlying stock itself. This chart shows the profit profile of a delta-neutral portfolio replicating a call option. The green line represents the theta gain. As the trading day progresses, the market maker accrues this time decay as a linear, relatively static baseline of daily profit. However, as the underlying asset's price moves in either direction, that linear hedge loses efficiency against the convex option. This generates accelerating gamma losses that immediately begin eating into the static theta profit buffer. This dynamic defines the gamma-theta break-even range. The GTBR is the precise price range where intraday exponential gamma losses exactly neutralize daily linear theta gains. This chart shows intraday profit based on price movement. Combining these Greeks forms a distinct parabola. The gray total P&L curve decays exponentially as price moves. The vertical yellow lines represent the GTBR, defining the portfolio's profitability limits for the day. This creates the primary rule governing the market maker's microenvironment. As long as the underlying stock price remains inside these yellow boundaries, the market maker safely absorbs market variance and ends the day in profit. If crossing the GTBR guarantees exponential losses, the logical question is why market makers do not continuously rebalance their delta to zero throughout the day. The answer lies in the frictions of continuous hedging. Every rebalancing trade incurs transaction costs and execution market impact, which drag down overall profitability. If the asset moves up early, the market maker could rebalance, instantly locking in transaction costs. If the price then reverts to zero by the end of the day, that unnecessary early hedge flips the total daily profit negative, destroying the entire theta buffer. Because of these strict economic penalties, market makers are heavily incentivized to delay hedging. They willingly absorb small delta imbalances, calculating that the stock will likely close within the GTBR. This rational delay tactic effectively accumulates a massive, unexecuted block of latent hedging demand that hovers just over the market, waiting for a trigger. The critical stress test occurs late in the trading day, when the underlying asset begins a sharp trend toward the edge of the GTBR boundary. When the price pushes past that threshold, a mathematical inversion takes place. Exponential gamma losses dwarf static theta gains, dragging total profit into negative territory. The required delta correction now grows exponentially larger with every subsequent tick outside the GTBR. At this specific moment, the operational reality for the market maker shifts entirely. Discretionary trading evaporates, replaced instantly by rigid, algorithmic risk limit enforcement. To survive the close and neutralize their delta, the market maker is forced into mechanical execution. They must buy the underlying asset into a rising market or sell into a falling market. This forced execution is pure inelastic demand. It is trading volume executed with absolute zero sensitivity to the underlying price of the asset. This sudden release of forced trend-following liquidity hits the open market all at once, creating a cascading impact on the underlying stock price. The market maker's ultimate defense against exponential book loss is the exact mechanism that weaponizes the options market into a driver of extreme stock volatility. We can validate this theoretical profit and loss model by looking at empirical market data across thousands of individual equities. The research calculates intraday momentum coefficients and groups them into deciles based on how close each stock's return came to breaching its specific GTBR. This chart plots momentum coefficients across deciles of normalized returns. Inside the first 5 deciles, returns remain within the GTBR, keeping momentum weak. But at the orange line, where return equals 1 GTBR, momentum violently spikes, correlating real-world data to the theoretical model. This proves that macro-level market data perfectly traces and validates the micro-level constraints of the individual market maker. This data lets us isolate the variables and test the institutional myth that raw short gamma exposure is enough to predict a squeeze. By comparing the predictive weight of short gamma against the GTBR hit variable in a regression matrix, the hierarchy becomes clear. Within the GTBR, short gamma possesses insignificant predictive power. Raw gamma alone does almost nothing. The predictive power of short gamma only becomes statistically significant when the GTBR is explicitly broken. The threshold breach is the mandatory activation trigger. This momentum effect is severely exacerbated when active, directional option traders hold the opposing long positions. In those scenarios, the market maker is forced to source their mandatory liquidity against highly toxic flow, amplifying the squeeze. Intraday momentum is not random price action, it's a deterministic output. The GTBR is the quantifiable threshold where market shock absorbers become momentum multipliers.